Hey guys, Ben here helping you earn more, spend less, and invest the difference. Now today I'm going to be talking about a very special topic. It's sort of the holy grail of stock market investing. And I know that's a big and bold statement, but honestly that might be an understatement. This is hands down the best way to invest in the stock market. For starters, this method is super fast and easy. Look guys, you can get set up and start investing using this method 5 minutes after you're done watching this video. And it's super easy. There's no knowledge about the stock market required. So you don't have to stay up all night poring over different companies' financial statements, their quarterly earnings, their profit and loss, their PE ratios. You don't have to dig deep into those boring numbers. Number two, it's passive. You can do this once and forget about it for 5 years, 10 years, 50 years down the road. Your investment is going to be doing just fine. Number three, it's probably the least volatile way to invest in the stock market. Historically, the stock market is up and it's down and it's sideways. So sometimes there's some big ups in a particular company's stock price. Sometimes a company goes bankrupt, like when Enron suddenly went bankrupt. So there can be some massive swings in individual stock prices, but using this method, you get a nice, steady, positive rate of return over the long run. In the long run, using this technique is virtually guaranteed to outperform even those Wall Street hedge fund billionaires that have nothing better to do than sit in front of their computer all day analyzing stock prices and charts and graphs and all that kind of craziness that, let's be real, you don't have time for that. You should be spending your time on your fantasy football team, not on PE ratios. In fact, using this method has beaten the Wall Street Titans for the last 9 years in a row. And in the last 15 years, using this method has beaten 92% of those billion-dollar hedge funds. Now, what is this method? Well, I wish there was a little bit of suspense, but judging from the title of this video, you already know that it's all about index fund investing. So what exactly is an index fund? Well, in order to understand an index fund, we got to first talk about the stock market just a little bit. So usually when you go out and you buy stocks, you're buying stock in an individual company. Maybe you buy Tesla or Microsoft or Google or Facebook or whatever's, trendy at the time. And so when you buy stock in Microsoft, you own a portion of the Microsoft company. And then if Microsoft does really well, the price of Microsoft stock will typically rise and you'll make a profit. If it does really poorly, then the price will go down and you're going to lose your money. So it's a little bit risky because then you got to start picking individual winning companies. And that's impossible to do. Even hedge fund billionaires have no idea which company is going to go up in value and which one will not. And I'll get more on that later. So then instead of just buying stock in one company, what if you bought stock in 10 different companies? You spread your money around and you bought a little bit in 10 different companies. Well, in that case, if one company did really poorly, you picked a loser, then hopefully the other 9 would do all right. And so overall, you would be just fine. But even if you buy 10 companies or 50 companies or 100 companies, there's still some risk involved because you still might pick more losers than winners. So what if you just simply bought every company? What if you could just buy shares in the entire US economy? If that was possible, then you wouldn't have to worry about how any one particular company was doing because you owned literally all of the companies. So theoretically, the other companies would be doing just fine, even though you had a few losers over here. You also had some that were doing average, and you had some real winners as well. So overall, your rate of return would be very nice and steady. So that's essentially what an index fund is. By buying shares in this particular index fund, you're actually buying shares in a lot of different companies. Now there are different index funds depending on what it is that you're trying to do. Now I highly recommend Vanguard index funds. I'm not affiliated with Vanguard in any way. This video is not sponsored, but Vanguard has some very, very low fee index funds that are usually considered some of the best in the world. So for example, you can buy stock ticker VOO, which is Vanguard's version of the S&P 500 index. So when you buy shares in VOO, you are actually buying shares in 500 different companies, all 500 companies that are in the S&P 500, which is essentially the 500 largest companies in America. Now, buying shares in VOO is going to be the biggest 500 companies, but what if you wanted to mix in some of the smaller companies as well? Well, in that case, you might want to buy Vanguard's index fund, VTI, their total index fund. And when you buy shares in VTI, you're actually buying small shares in roughly 3,600 different companies. So you are extremely well diversified, and it doesn't matter if 1 or 2 or 10 of those companies are losers, because the rest of them are going to be doing just fine, and your rates of return is going to be very good. So when you buy index funds, you are essentially buying into the average of the US economy. If on the whole the economy does well, your index fund will do well. If it does poorly, your index fund will do poorly. Now you might be saying that you think that you're smarter than everybody else and that you can pick individual winners. And maybe you have had some success in the past with picking good stocks. Maybe you bought Facebook when it was cheap, or maybe you bought Amazon when it was cheap. But just because you made a good trade and you made a lot of money on it doesn't mean that you are smarter than everybody else. It just means that you got lucky. Because while stocks can suddenly rise in value, they can also suddenly fall in value. Those of you guys that have been around long enough might remember Enron, where they went bankrupt essentially overnight. And if you're liking Facebook right now, well, remember how fast MySpace disappeared into oblivion? Facebook is only hot and trendy until the next hot and trendy social media site wipes Facebook off the planet. So please don't for a second think that just because you've made some good picks in the past that you are somehow smarter than everybody else, and that in the future you will continue to make nothing but good picks, because eventually the law of averages is going to catch up to you, and you're also going to make some bad picks. Because the reality is nobody knows what stock is going to go up or down. Now, back in 2008, legendary investor Warren Buffett, one of the richest men in the world, challenged hedge fund managers to a bet. He bet anyone that was willing to take his bet $1 million. He bet that a simple index fund from Vanguard over a 10-year period would outperform whatever actively managed fund that they wanted to put up against him. Now, there's only one person that had the balls to actually call Warren Buffett out on this bet. And that's a big deal, because these guys operate billion-dollar funds. Like, their whole job in life is to pick winning stocks. And then this guy is saying that simply by ignoring everything that they're saying and everything that they're doing, you can make more money passively just by investing in index funds. So only one person was brave enough to stand up for their profession and take him up on this bet. Well, 10 years later, Warren Buffett's fund had almost 4 times as much money in it than those hedge fund gurus had. So even the professionals have no idea what stocks are going up and which ones are going down. In fact, not even Warren Buffett knows which are going to go up or down. Back in May, Warren Buffett famously sold roughly $4 billion worth of stock in various airlines. Now, if we look at the price of Delta stock at the time that he sold it for roughly $21 a share. And here we are a handful of months later, and Delta stock is now over $40 a share. So he unloaded all of his stocks in these airline companies for roughly half of what they are worth only a few short months later. So even professionals like Warren Buffett, as great as they are, don't always get it right. And that's why index funds are so great, because you don't have to get it right. You just play the averages. So look, guys, you can get set up with this super fast. Whatever your favorite stock trading app is, maybe Robinhood or M1 Finance, both of those guys offer fractional shares. So you can literally get started investing in this technique with as little as $1. $1 can buy you a fraction of one share of either VTI or VOO. So you will own a fraction of a share of fraction of a company. So realistically, you own microscopic amounts of a lot of different companies, but those companies over time will, generally speaking, go up in value and you will make a nice profit. Historically, the broad market averages roughly a 10% rate of return, which means that if you just invest in a broad index fund, you will double your money roughly every 7 years. If you found this video useful, be sure to subscribe, leave a comment down below, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.